On today's Hashi, I'm discussing Scott Bessent's comments on a recession and housing, Cotality's home price insights for September, and the biggest drop in median monthly housing payments since November of 24. Today is Tuesday, November 4th, 2025. I'm Byron Lazine, and the Hot Sheet starts now. Live from Las Vegas. Good to be with you. It's a pleasure to be with you wherever you are tuning in from. Let me know in the live chat. Let me know how if you were just coming in, rolling in from the role play over at BAMX, the members only role play we do every single Tuesday, 9 a.m. Eastern, 6 a.m. on this coast. Let me know how it went. Did Tom and Lisa do well? How did they do? Okay. Fidel says they did okay. It was fire. That's good to know. So nobody missed me. All right. If you missed these comments from Scott Bessent, I'm going to break them down for you. Scott Bessent, Secretary of Treasury, and he had some comments on what might happen to the economy, floating the R word out there, probably trying to pressure Jerome Powell and the FOMC to make the cut in December that was expected and now is seemingly up in the balance. All right, let's go to Haley. We've got a clip from Bessent. Let's go to that now, and then we're going to break down not only this clip from State of the Union on CNN, but as well as some of his comments in a 7,000-word essay that he recently wrote.
Do you think that the U.S. is at risk of a recession if the Fed does not continue to drop rates?
I think that we are in good shape, but I think that there are sectors of the economy that are in recession, and the Fed has caused a lot of distributional problems with their policies. I wrote a 7,000-word essay on that. We've seen the biggest hindrance for housing here that are mortgage rates. So, if the Fed brings down mortgage rates, then they can end this housing recession. Low-end consumers who have gotten killed under President Biden, these high rates are hurting them because they have debt, not assets. Mm-hmm. So I think that there are sections of the economy that could go into recession.
All right, Secretary Bessent.
All right, so he kind of finished on the housing topic a little bit stronger than he had started. At one point in the, he said he thinks housing is in a no. You can just go all the way there, Mr. Bessent. You can just say it in plain English. Housing is and has been in a long recession. So, yeah, not all sectors of the economy are in a recession. To his point, that's been acknowledged. We haven't seen a overall recession. We did see Q1 GDP go negative, but Q2 obviously bounced back in a significant way. If you're using the old metric of 2 quarters back to back in the negatives for growth on GDP, then you're in a recession. Housing has been in that recession. High affordability issues, unaffordable. You have high interest rates and then low transactions. And that is where we're closing out this year. The same story of the last three repeated itself essentially this year as really this year has taken full shape. We know what it's going to look like. It might be a tick above 4 million existing home sales, but on the overall, still a real estate recession. Now, are there signals that we can come out of it next year? I would agree with Bessent here. The Fed can change a lot of that with an accurate not an accurate, that's the wrong word, a decisive plan for 2026 with where the policy is going to be on rates. You have inside of this story here, there's a Newsweek story that covers some of Scott Bessent's recession issue and issues on housing. You've got Mark Zandi quoted in here. Most of the problems in the U.S. housing market have been with regard to sales, right? We've seen the suppression of sales. Agents and real estate professionals in every market have felt that. They've been very depressed because of the interest rate lock, the housing lock. But the thing that's going to be problematic, okay, the bigger problem with these sales numbers is this adds to the concerns about a recession here in the second half going into next, is home building, right? What has led to recessions in the past? Well, one of the early indicators is when the construction and the contractor market starts to lay off, and we've seen that decline in employees. So that's one of those indicators that the overall economy is heading into the wrong place. So home building is going to weaken here significantly, according to Zandy, chief economist with Moody's. And that's just another reason to be nervous about the economy's staying power and getting through without going into a recession. Steve Moran, who's the Federal Reserve governor, says if you keep policy this tight for a long period of time, as the Fed is doing right now, despite those two previous cuts, then you risk that the monetary policy itself is inducing the recession. That's why the market reacted negatively to Jerome Powell's comments on the last decision. When we looked at it last week, the market bounced off of the comments of uncertainty for December. Saw the 10-year pop, 30 years back up to about 6.25. Had the December plan been decisive and kind of stamped a high probability of a cut in December, that pricing in that the market was already doing for that cut probably induces a little bit more of that momentum that we had. We stay in those low sixes like we had right before the meeting, and we see more momentum on the rates. He says, Moran says, I don't see a reason to run that risk if I'm not concerned about inflation on the upside. There's a lot less inflation concern, particularly around housing and shelter right now. Even Jerome Powell acknowledged that, because he knows that 2-year lagging data in CPI, for example, is about to come forward. We're starting to see that. So, people get inflation. Inflation has to be high. Prices are high. No, the new price level that we broke through from printing all this money is where we're at. That's not inflation. Inflation is the rate of these prices continuing to move up. And inflation is not, if you look at this objectively, not that big of a concern moving forward into 2026. Most of the analysis has this continuing to move down over the next year, 2 years, to that 2% target. 2% target's rather arbitrary anyways, but that's the number that we have. But you're not going, where people get confused is like, oh, well, when prices goes back to 2019, that means inflation is no, you're not getting back to 2019 levels on anything. And I don't believe you'll get there on home prices at any time in the future. Cotality now has their report out for September. So U.S. home prices in September, according to Cotality, went up 1.2% year over year, and inventory hit the highest level since 2019. So we've got 2019 highest level since 2019 inventory levels. Doesn't mean we're going to go back to 2019 price points. 20% of metros, according to Cotality, saw annual price drops, while 75% of top metros remain overvalued per this September report. Haley, if we can get into some of the slides, all the slides will be available for you inside of BAMX. So go to school.com/BAMX. You can try BAMX for the next 7 days. All the slides that we use on the hot sheet each and every single day get uploaded here for you, as well as the hot sheet show notes, so you can use in your own communications, one-on-one communications with clients, or your own hot sheet style show in your market. National home price growth moving up the 1.2% year over year, and the forecast here over the next 12 months, so September to September next year, they've got it at a 4.1% here. If we look just month over month forecasts, the projection is that we'll move sideways flat. A 0.02% increase is not going to change anybody's lives, but they do not have a decline, as we saw this month, where we saw the 0.2% drop. 4.1%, the bigger story on the forecast, sticking with 4+% on a price point increase moving over the next 12 months is significant. Top 10 hottest markets right now, according to Cotality, you see this is Midwest, a little bit of Northeast, and that's where the prices are rising the fastest, where you have the least amount of inventory, all dashed in that region there. Northeast and Midwest are the top 10 housing markets right now. It's all based on supply and demand. I was just having this conversation, unfortunately, with my parents yesterday. Like, yeah, we don't really think we want this place. It's like, hey guys, it's a supply and demand thing. If you want to be competitive in a high inventory market, there's gonna be a lot of positioning around price. Just the way it is, and sellers, even when they're your family members and you love them, it's like, hey, yes, you guys did do some nice things to the place, but there's a lot of inventory. And when there's a lot of inventory, buyers just have this leverage. And when they have that type of leverage, the little things and features and nice, investments you make in don't matter as much. I'll just go to the next one and negotiate a better deal and put into the property the things that I want, right? We get that. And that brings me into the top 10 coolest markets. One of those markets that I was discussing with my parents is on the list here. And you see where the top 10, Haley, if you can go to the top 10 coolest, please. You can see here on the list where the top 10 coolest markets are all kind of focused into that Gulf Coast. The majority of them, 6 out of 10 anyways, are in Florida. You got Gulf Coast, you got Cape Coral, you got Naples, Punta Gorda, Sebring, Florida, Northport, Florida, Brownsville, Florida, and Sebastian, Florida. Sebastian, obviously, on the East Coast, but a lot of Florida mixed in there. And then you've got a little bit of Texas and a couple of outliers, one location in Illinois and one in Hawaii. So those are your top 10 coolest markets, according to Cotality. Affordable areas, according to Cotality right now, the most affordable, you've got $128,000 to $169,000 range. Top 5, most affordable for the lowest U.S. median sale prices. We're in West Virginia, Johnstown, Pennsylvania, Beckley, West Virginia, Need, Oklahoma, and Muncie. And so look at, you get the West Virginia, the Pennsylvania, they're in the top 3. That's where you saw some of those, that mid, west, up to the eastern seaboard, northeast. Northeast obviously very expensive, but when you get into some of those more affordable markets, I think you're going to see price jumps where you saw the hottest market price jumps in those types of areas for quite some time, because it's very difficult to find homes in this price range. Which areas are affordable? If we go to least affordable, okay. So if we're looking at the least affordable options, they're in the blue bars, Haley. If you go to the blue bars, next one down, you've got San Rafael, California. Next one down from where we were. There you go. San Jose, San Francisco, Anaheim, Santa Cruz. And so this is all California, top 5 in the least affordable category, 1.175 from Santa Cruz all the way up to 1.6 on San Rafael. And then high risk home price trends right now. So they update this every single 30 days. Here are the markets where you have the highest risk on price moving down. Okay, so this isn't talking about anything long term with these markets. These markets aren't disappearing off the face of the earth as much as Redfin thinks that they will for climate reasons. These are just markets that are experiencing the most downward pressure on price in the now, and those are Cape Coral, Fort Lauderdale, Lakeland, Palm Bay, and West Palm Beach. Top 5 high risk home price trend markets, all in the state of Florida. All right, speaking of Redfin, we have a report out here from Redfin this week on payments. Okay, so Redfin is looking at median monthly housing payments, and they are right now on the biggest decline in years. Okay, median monthly housing payment posts the biggest decline in nearly a year. or not years, but nearly a year. U.S. median monthly housing payment was $2,500 plus during the 4 weeks ending October 26. It's down 1.4% year over year. It's the biggest decline since a year ago, November 2024. This is something to note because we've seen multiple years now, 2+ years. We look at the Realtor.com report of rent prices going down in this country. And so that is now starting to show up in those inflation shelter reports. Now, if you've got median U.S. monthly payments starting the same trend as rent, every month that goes by, you can just kind of chip away a little bit at this unaffordable situation that we are in. And over time, you get salaries to increase. Monthly payments fell mainly due to the rates that we saw last week. So momentum on rates getting into the high fives is going to be the biggest impact that we can have on rates. Hey, if we go to some of the slides that we have on Redfin here, here's your biggest drop, 1.4% year over year. And you're seeing that this time of year, you also have a little bit of the seasonality to the drop. You saw it in 22 anyways, and then you saw it again in 2023. You saw a slight drop in 2024. So you will have that seasonal drop right in the beginning of the year. As we get into the spring, these payments tend to increase. Why do these payments tend to increase? Because you have the most competitive situation in those spring markets, which is why when we're positioning for sale, like, is there a best time to sell? It's pretty clear. It's pretty clear. You want to be positioned when the competition is at the highest. If money is going to be the most important, people are willing to stretch that monthly payment in the months of February, March, April, leading into May, as those closings kind of close out. And if they're willing to stretch their payment, be more competitive, that means sellers get more money. And that's where you see a lot of the sellers obviously delist this time of year going through the end of the year. Median asking price is up 2.9% year over year. 4-week rolling average comes in at 398,000, just shy of 400,000 there on October 26th on the 4-week moving average, up 2.9% year over year. Home buyer demand index is down. So demand, according to Redfin's data, demand is down 10% year over year. So this is a value of Redfin's seasonally adjusted home buyer demand index based on the request for home tours. So they're seeing a lot of home tours, obviously, on the portal and other home buying services. They've got home buyer demand down 10% year over year. It's interesting because that means cash interest is down, because we know that mortgage applications are up. And so just an interesting data point there, that the demand has dropped on their index 10% year over year when we're seeing mortgage application increase. We have seen cash sales come down over the last number of years. Median sale price is up 1.9% year over year. That's in line with most of the reports that we see on sale price. All right, speaking of cash, let's go to Zoodealio. Our partners over at Zoodealio, every single BAMX member has Zoodealio's platform included in their BAMX subscription. It's a $2,400 value. Just get it free as a BAMX member. You could compete with iBuyers. They protect agents and do not try to cut out the agent from the process. They know how important you are, as opposed to their competitors who rip off their own campaigns, those being the likes of Open. All right, top 10 housing markets for cash offers over the past week. So here are the markets over the past 7 days that have seen the most cash offers. Number 1, where I'm sitting here today in Vegas, beautiful Las Vegas, Nevada. Atlanta, Georgia. Number 2, Houston. 3, Jacksonville and Denver round out the top 5. Santan Valley in Arizona, Austin, Orlando, Dallas, and Miami. There's your top 10 for cash housing offers, or cash offers over the last week on single family housing. 10-year treasury is down a little bit today, but we're really still just kind of hanging up over 4% on the 10-year. 4.089 is where we start the day on the 10-year. Looking at where the 30-year fix ended yesterday, came in a little bit hotter than on Friday of last week, came in at 6.34 on the end of the day read yesterday for according to Mortgage News Daily for the daily read. 6.34 on Mortgage News Daily. 6.28 is where we ended Friday. So 6.34, the highest daily read we've seen in a couple of weeks. And, until you get something positive, whether it be a signal from the Fed that they're going to cut in December, or, maybe that the shutdown ends, and, I don't really know how the market's going to react to that, because the market hasn't overreacted to the shutdown. So I don't know that there's a big, move that we're going to see if the shutdown ends. I think it'll help consumer confidence. I mean, if I say if the shutdown ends, as if it'll never end, I'm sure that it will end. I think it helps consumer confidence more than anything. I don't know that it'll be a market mover. We'll have to wait and see, obviously. But there wasn't a huge reaction to this shutdown, and there hasn't been much movement from that yet. All right. There you go. There's your hot sheet here live from Las Vegas. If you're here, maybe I'll see you today at the Zillow Unlock event. I'm gathering I see Gary Ashton here in the chat. I believe Gary's in the chat. As Gary would say, I'm gathering all the intel. I'll be sharing it certainly on Knowledge Brokers Podcast on Friday. If you're unfamiliar with Knowledge Brokers Podcast, separate channel, separate Apple, separate Spotify. Just look up Knowledge Brokers Podcast and subscribe to that. We've got a big show planned here for this Friday, and looking forward to seeing you over there. All right. There you go. There's your hot sheet. I will see you guys next time. Until then, toodaloo.